This is a demonstration of exercise 425, preparing closing entries from an adjusted trial balance, preparing a post-closing trial balance, and calculating the current ratio. The problem gives us the adjusted trial balance for Marx Bowling Alley as of December 31st, 2018, and our first requirement is to prepare the closing entry for Marx Bowling Alley. So I have the accounts already listed, and we're just going to include the amounts from the adjusted trial balance. We notice first that we're going to be closing service revenue. So we go to our adjusted trial balance and we see that service revenue has an $85,000 credit balance. So to close that account, we would debit service revenue for $85,000 and we would credit our temporary account income summary for $85,000. Next, we're going to close our expenses. So we would do the same thing. We would go to our adjusted trial balance and take the balances from all of our expenses. They're all debit balances, and so we're going to credit each one of those so that when we post these to these accounts, they're all going to have a zero balance. The purpose of the closing entries is to, first of all, summarize the amounts so that we can determine our net income or net loss, but also to get these accounts to a zero balance for the beginning of the next accounting cycle. I had income summary updating for the total of all of our expenses, so we debit income summary for the total of $77,625. Now then we need to close income summary. We had credited income summary for $85,000, debited income summary for $77,625, so income summary had a credit balance of $7,375, and now we want to close income summary, so we need to debit it for $7,375 to bring it to a zero balance for the next accounting cycle. When we close income summary, if income summary had a net income and we debit income summary, we credit retained earnings for $7,375 because that is what a net income does. It increases retained earnings. If it were a net loss, we would debit retained earnings and credit income summary, and it would reduce retained earnings. The last closing entry is to close the dividends account. We know that dividends decrease retained earnings, so we debit retained earnings for the $31,000 balance, and then we credit dividends for $31,000, and that is going to, after posting, reduce our dividends account to zero and effectively close it. The second part of this problem is to prepare a post-closing trial balance. The purpose of the post-closing trial balance is to check the debits and credits in the general ledger accounts that are still open, which are only going to be the balance sheet accounts, to make sure that as we made the closing entries that they were all posted and posted correctly and our debits and our credits equal. So except for retained earnings, all of our accounts, all of our permanent accounts should still have the same balances in the general ledger that they had for the adjusted trial balance, but we're going to go ahead and list all of them in our post-closing trial balance and check our balances to make sure that our debits and our credits equal. So I'm just listing the amounts. These are actually, up until we get to retained earnings, would be the same amounts that we have in the adjusted trial balance. Just make sure that when you are recording these that you're putting them in the right column and that you're transferring them at the correct amount. The only one again that's going to have a different balance is going to be retained earnings, and we're going to go ahead and record $90,625, and I'm going to explain where that number would have come from. This retained earnings number is the beginning of the year retained earnings. The retained earnings would not have that balance after we make these closing entries because we would have credited it for an additional $7,375 and we would have debited retained earnings for the $31,000 when we closed dividends. So that is where the $90,625 balance for retained earnings came from. And we notice that our debits and our credits equal, so our accounts are in balance at the end of the accounting cycle to start the new period. The last part of this problem was to compute the current ratio for Marx Bowling Alley. We know the current ratio is equal to total current assets divided by total current liabilities. So I have in my spreadsheet the total of the current assets, which is $26,750. Where did that number come from? It is the total of cash, accounts receivable, office supplies, and prepaid insurance. And you see down here that sum is $26,750. So total current assets. How about current liabilities? Current liabilities are going to be accounts payable, utilities payable, salaries payable, and unearned revenue. And if you notice here, the sum of those is $11,125. So to get the current ratio, we divide current liabilities into current assets, and we have a current ratio of $2.40, which means that for every $1 of current liabilities, we have $2.40 of current assets. So our current ratio is $2.40, and that is the conclusion of the demonstration for exercise 425.